An unprecedented $10 trillion wall of publicly held United States Treasury debt is scheduled to completely mature and demand full reallocation within the next 12 months alone. The gross sovereign liability of the American superpower has quietly breached a historic $39 trillion threshold, officially crossing above 120% of the nation's total gross domestic product for the first time since the desperate industrial mobilization of World War II. Because the baseline carrying costs on these massive international loans have aggressively doubled since 2021, the annual interest vortex has systematically expanded out of control. These interest obligations have completely bypassed the $1 trillion a year milestone since 2024, converting the domestic balance sheet into a terminal mechanism that expends far more capital on servicing its historical debts than it allocates towards sustaining its actual physical infrastructure. Yet, if you look at the immediate behavioral reaction of Wall Street right now, the aggregate response from financial commentary networks and trading desks has been completely quiet, almost entirely tranquil. The major equity indices trade near historic highs. Corporate commentators treat daily market dips as isolated technical fluctuations, and retail investors remain completely blind to the reality that the foundational monetary rules of modern capitalism are about to be permanently rewritten. This is a classic systemic distortion. The public remains trapped in a state of superficial complacency, looking exclusively at nominal equity valuations on a screen, entirely oblivious to the reality that the underlying plumbing of the sovereign debt network has reached a critical breaking point. The confirmation of Kevin Warsh as the next chair of the Federal Reserve is being treated as a routine administrative transition, when it is in fact the catalyst for a fundamental regime change designed to alter the definition of economic reality. This profound disconnect between real sovereign solvency risk and paper asset markets is a direct manifestation of the specific psychological blindness that legendary global macro operators recognized to accumulate immense fortunes. Mainstream financial models are built on the naive academic dogma that trading markets are highly efficient structures that accurately calculate and price real-world structural threats at all times. In reality, human institutions react far too slowly to systemic institutional decay. In the opening phase of a genuine monetary crisis, the financial establishment remains in a deep state of collective underreaction, convincing themselves that a compounding $39 trillion fiscal catastrophe can be neatly managed through standard political adjustments, corporate optimization, or minor regulatory calibrations. Because of this collective naivety, asset valuations and consumer confidence remain artificially elevated, trading at incredibly cheap rates relative to the real inflationary danger ahead. Everyday citizens confidently expect their accumulated cash balances, traditional savings, and fixed income portfolios to retain their baseline purchasing power over the next 2 decades. It is only when the real-world structural scarcity forces its way through the technical defenses of the banking architecture that the crowd suddenly awakens, shifting instantly from absolute denial into a chaotic, cascading market panic. We are living through the final chapters of that underreaction phase right now. The collective consciousness has not yet grasped what occurs when a newly confirmed Federal Reserve leadership implements a total operational regime change designed to systematically devalue the carrying weight of public liabilities. To understand the architecture of the upcoming policy pivot, we must first tear down the highly coordinated myths surrounding the origin of modern price increases. For the past 5 years, the public has been continuously told that persistent domestic inflation was an accidental byproduct of external disruptions, blaming overseas military escalations, global logistics bottlenecks, and temporary healthcare emergencies. This narrative is a complete institutional farce designed to absolve central planning of its direct consequences. Sustained systemic currency debasement cannot exist within a market economy unless the central bank actively runs its printing presses fast enough to flood the financial architecture with excess synthetic liquidity, outracing the actual expansion of real gross domestic product. Real inflation is not a localized supply issue. It is a direct math equation of currency volume versus tangible output. When localized economic shocks occur, such as a sudden tariff implementation or an abrupt spike in the price of commercial beef, the market is simply doing its job, repricing a world where a specific physical resource has become scarcer. This localized price movement is an easily traceable event that reflects real world supply physics. It is not monetary inflation. Walmart adjusting its retail tags to reflect a bad agricultural season is how a functional market economy signals scarcity. Yet, the Federal Reserve has historically stepped into these situations to print massive amounts of synthetic liquidity under the guise of stabilizing the economy, dramatically expanding its balance sheet to a staggering $7 trillion through the aggressive purchase of long term government notes and mortgage backed assets. The incoming monetary leadership operates under the strict realization that this massive $7 trillion asset hoard is the genuine source of long term currency destruction. If the central bank can run its printing machine quietly and methodically shrink this bloated balance sheet, it can theoretically pave the path for lower short term interest rates without immediately triggering an overt currency collapse on paper. This brings us directly to the first major structural policy adjustment proposed by Kevin Warsh during his confirmation hearings: the wholesale replacement of traditional inflation metrics with a highly sophisticated mathematical filter known as the trimmed mean methodology. For decades, the public was forced to look at core inflation measures, which crudely discarded food and energy costs as a volatile baseline guess. The incoming regime intends to abandon this archaic approach, replacing it with an automated mathematical system that ranks every single price change in the economy from the lowest to the highest, and then systematically trims away the extreme movements on both outer tails of the distribution. The statistical disappearance of real cost. The Dallas Federal Reserve's existing trimmed mean model actively discards a massive 55% of the total real world consumption basket, preserving only the central 45% of goods and services whose underlying prices show the highest degree of artificial stability, the illusion of stabilized targets. When you pass real economic data through this aggressive mathematical filter, the entire macroeconomic reality changes instantly. A recent nominal inflation print that registers as an elevated, highly problematic figure under standard metrics magically drops down to an elegant 2.4% under the trimmed mean calculation. The justification for premature easing. By simply altering the statistical lens through which reality is observed, the central bank can mathematically declare a total victory over inflation, bringing the official index significantly closer to their arbitrary 2% target. This statistical engineering provides the structural cover necessary to implement aggressive short-term rate cuts, even while real-world working-class consumers continue to experience severe financial pain at grocery checkouts and utility meters. If this deep dive into the hidden physics of central bank manipulation has broken down your illusions about traditional financial advice, you must realize that standard wealth preservation strategies are actively designed to fail under this upcoming monetary regime. Standard advice tells you to leave your wealth inside traditional paper assets, trusting that central planners will protect your baseline purchasing power. This is an absolute trap. If you want to insulate your capital from this upcoming transition, you must learn to track real-world physical flows rather than abstract paper metrics. There are specific structural toolkits and asset allocation frameworks designed to navigate financial repression in real time, allowing independent producers to locate structural arbitrage opportunities before the broader market enters its inevitable overreaction phase. Shifting your focus toward realistic macroeconomics is the single most important operational decision you will make this decade. The secondary objective of this operational regime change is to orchestrate a massive, silent wealth transfer through the deliberate implementation of deeply negative real interest rates. To understand the exact physical mechanics of this hidden state extraction, look directly at how a basic loan transaction operates between two private individuals when standard currency mechanics are disrupted by persistent intervention. Imagine you decide to acquire a physical piece of industrial technology that currently retails for exactly $100. Because you prefer to conserve your operational liquidity, you borrow $100 from a private acquaintance, executing a firm agreement to fully repay the principal balance in exactly 12 months alongside a fixed 2% interest premium. 1 year later, you fulfill your legal obligation, handing your friend exactly $102 in nominal cash currency. However, during that 12-month interval, systemic monetary expansion has quietly driven the actual real-world market price of that physical technology up to a staggering $120. Your counterparty receives the nominal $102 as legally recorded, but that specific currency can no longer purchase the physical utility they could have effortlessly acquired when they originally chose to part with their capital. In absolute real terms, your lender has suffered a permanent, unrecoverable extraction of their actual purchasing power. You, conversely, retain absolute possession of a physical asset now valued at $120, while only expending $102 of devalued nominal wealth to completely extinguish your legal liability. Now, scale this exact mathematical fraud across the entire international financial system. Replace the individual borrower with the United States Treasury, and replace the private lender with every domestic saver, international institution, and retirement fund currently holding a U.S. government bond. Instead of a minor $100 transaction, apply this mechanism directly to the entire $39 trillion national debt mountain. Because the trimmed mean framework historically lags behind real-world consumer expenses and structurally underestimates the rising baseline costs for physical housing, food, and transport logistics. Its official adoption allows the central bank to lock interest rates down prematurely. While the Federal Reserve publicly celebrates its technical target success, ordinary citizens will naturally recognize the permanent loss of their currency's value and adjust their real-world behaviors. Workers will demand larger nominal wage baselines, corporations will aggressively raise retail prices to outpace raw resource costs, and landlords will systematically build massive safety premiums directly into long-term commercial contracts. These behaviors quickly become entirely self-fulfilling, solidifying a state of elevated, permanent, underlying inflation across the real economy. By programmatically keeping short-term nominal interest rates pegged significantly below this actual rate of physical asset appreciation, the government gains the structural ability to continuously pay back its historic multi-trillion-dollar sovereign liabilities using deeply devalued counterfeit paper dollars. This is the only politically feasible solution to an otherwise mathematically unpayable debt crisis: the systematic liquidation of public purchasing power to silently dissolve the state's obligations. Under this upcoming framework of financial repression, the domestic population will be violently bifurcated into two distinct economic groups: those who hold high utility fixed debt backed by real physical assets, and those who store their past labor inside paper promises. The clear structural beneficiaries of this environment are existing homeowners holding long-term, fixed-rate mortgages. Their nominal monthly payment remains completely unchangeable for 30 years, while systemic inflation continuously devalues the real purchasing power of the currency they surrender to their financial institution. In real terms, their actual debt burden continuously dissolves without requiring them to allocate a single extra dollar of real economic output, while the nominal valuation of their underlying land and property scales upward in direct alignment with the expanding money supply. The exact same systemic windfall applies to individuals holding long-term corporate debt, fixed-rate student liabilities, or physical capital equipment loans. They successfully captured high purchasing power dollars in the past and are now legally permitted to cancel those liabilities using cheap currency. Conversely, the traditional saver, the fixed income retiree, and the conservative wealth builder face an incredibly hostile environment. As the central bank uses its trimmed mean metric to justify suppressing short-term interest rates, commercial banking entities will instantly lower the yields paid out on standard cash accounts, money market funds, and certificates of deposit. Because the true unadjusted rate of real-world consumer inflation continuously runs faster than the nominal yields provided by these traditional savings vehicles, capital left inside the standard banking grid suffers a compounding, silent destruction of actual purchasing power. The demographic that will receive the absolute worst economic outcome under the central bank pivot is the upcoming generation of first-time homebuyers. While the financial press claims that central bank rate cuts will naturally restore affordability to the housing market, the underlying mechanics of the bond network will produce the exact opposite result. Long-term interest rates are not determined by the administrative decrees of the Federal Reserve boardroom. They are set by the aggregate actions of millions of sovereign bond market participants who look exclusively at physical realities rather than sanitized statistical models. When global bond vigilantes realize that real-world inflation is being systematically allowed to outrun interest rates to slowly dissolve government liabilities, they recognize that every future fixed interest coupon paid by a long-term bond will be worth substantially less in real terms. To protect their wealth from this permanent sovereign devaluation, international investors violently rebel against central bank narratives, demanding significantly higher upfront long-term yields before agreeing to lend capital to the state for 10 or 30 years. This structural market rebellion is already unfolding in real time. Since late 2024, the Federal Reserve has actively attempted to ease monetary conditions by executing 6 consecutive short-term rate cuts. Over that exact same chronological window, the benchmark 10-year Treasury yield completely decoupled from the Fed's boardroom path, rising steadily upward as the global bond market aggressively priced in permanent structural inflation. This defensive market pricing recently pushed the 30-year Treasury yield to an aggressive 5.13%, marking its highest macroeconomic level since the onset of the 2007 financial crisis. Because the 10-year Treasury yield functions as the global benchmark pricing anchor for all long-term domestic consumer credit, this upward surge in long bond yields translates directly into structurally higher mortgage rates for the public. First-time homebuyers are completely trapped in an unyielding financial vice. They must confront historic nominal property prices driven upward by years of aggressive currency expansion, while simultaneously facing surging mortgage interest costs driven by the global bond market's inflation panic. This structural barrier is further intensified by the Federal Reserve's automated plan to shrink its balance sheet. As the central bank systematically pulls back from its regular role as an institutional buyer of long-term government debt and mortgage-backed securities, a massive source of structural market demand completely vanishes from the financial landscape. This sudden drop in institutional support forces asset prices down and drives yields even higher, maintaining a continuous unyielding upward pressure on the real cost of long-term capital. Faced with an economic committee where internal pushback and intense bureaucratic debates are regular operational realities, independent financial participants must completely discard traditional paper wealth preservation frameworks. For individuals possessing a high risk tolerance and a clear operational view of monetary history, shifting capital out of the digital banking system and directly into tangible commodities like physical gold serves as a foundational defense strategy. Gold functions as an ancient, highly resilient, tangible asset that carries zero counterparty risk and cannot be programmatically diluted by central bank statistical engineering. Historical data confirms that tangible gold prices maintain a powerful inverse relationship with real yields, which are simply nominal interest rates adjusted for the true rate of physical inflation. Whenever the real inflation rate outpaces the nominal yields paid out by commercial banks, real yields drop into deep negative territory, and gold historically holds or dramatically increases its purchasing power as capital flees the devaluing paper architecture for risk-averse individuals who require predictable income streams but must insulate their wealth from financial repression. Treasury inflation-protected securities, commonly known as TIPS, provide a reliable structural alternative. Unlike standard government bonds that pay a rigid, vulnerable nominal return, TIPS are specifically engineered to protect baseline purchasing power by automatically adjusting their underlying principal balance in direct alignment with changes in the consumer price index. When the bond reaches its ultimate maturity date, the investor is paid out against the inflation adjusted principal, ensuring that the stored capital successfully survives the systemic devaluation process. America's historic $39 trillion national debt crisis is a mathematical reality that cannot be resolved through conventional fiscal austerity or basic political promises. Allowing real inflation to systematically erode the real value of public liabilities is the most politically feasible and realistic pathway available to the state architecture. The implementation of the trimmed mean framework accelerates this process, not by accidental design, but as a mandatory structural byproduct of systemic survival. Protecting your personal capital requires recognizing this macro engineering blueprint long before the broader market enters its final reactive panic.